There are thousands of index fund and ETF in the United States. And the reason to have the index fund and an ETF, because the passive investment strategy using this benchmark is pretty straightforward and easy to calculate. And there's a lot of benefit of using the ETF we just discussed before. But now, before we do that, we need to have a good benchmark. So, how do we adopt and attract an equity benchmarks? Now, what is the basic uh, predefined character we need to be aware of for benchmark? The first one, actually, we talk about four major items here. The first one, and actually I view is very important because I actually developed an index based on my personal algorithm called Chow ratio. So to select what index should I do to adopt the Chow ratio for calculating an index, I have to consider all those factors here. The first one is the breadth versus investability. Breadth means how many security or stocks that your index need to cover. All right, like S&P 500 obviously is a minimum 500 company. Usually 505 or 503. It vary, but it's about 500. And you understand that the more stocks involved in the index you're going to track, you're going to have a higher cost for that. So large coverage mean breadth is going to increase your cost, right? And because you're going to involve a large number of security. And if it is outside the large cap, you know that there is some of the index is probably is not very liquid. So man, mean you may not actually getting the price you want, all right, or you probably have to pay high cost to require the security. So the investability, it's very important for us to concern is that to be efficient to invest. Okay, so this is the first one is the breadth versus the investability. Now, let me before I talk about the liquidity, the investability not necessarily mean illiquidity. All right, the investability meaning that whether those security had a good functioning market for trade. All right, so that's called investability. For example, some of the equity may not be actually tradable. Okay, so so the first one is investability. The second one is the liquidity and the reconstitution. Okay, liquidity, it, it's important when you have to rebalance that portfolio. We call reconstitution. Right, reconstitution pretty much is the rebalance with different composite. Now, if you are dealing with some of the illiquid asset, then every time you do the reconstitution, it's going to involve higher cost. So the second one is liquidity versus reconstitution. The third, of course, is the flow adjustment. Okay, flow adjustment, and the versus the rebalancing cost. Now the flow cost, the flow adjustment we just discussed before. Let me put it out here. We talk about some of the share is the closed held shares or cross holding share. And if you have that in your index, then every time you do the rebalance, you have to reconsider that flow adjustment. Okay, because this index you have is mainly is to track. You construct a portfolio to track that index. So in order to have a more robust tracking, then you have to make a precise flow adjustment. Otherwise, your share understanding is not correctly reflect the true value of the index. Right. So this is another factor we need to consider. The last one is objectivity versus subjectivity. Right. This one is this. think about that. If you want to construct an index based on Nasdaq 100 versus S&P 500, what is the difference there? The Nasdaq 100, all right, this is more objective because this is the index, market index already there called Nasdaq 100. So you can actually construct an ETF based on that index called QQQ. Then you have no problem because these are the component of the index of the stock inside the index is a public information. All right, so everybody have to have it because Nasdaq have to disclose that free. However, S&P 500, the constituent inside the element of the 500 company, is owned by Standard & Poor. Okay, and how do they select the 500 company? It's a subjective route, and then the component name, everything, is right of S&P. It's like a private right, so it's a subjectivity here. So you don't know exactly what type of the stock they select, what the rule of their selection. Therefore, every time you want to reconstruct your portfolio or rebalance your portfolio, you have to subject the cost to obtaining the list from the S&P Standard & Poor. So this is another additional cost. Right? So the objectivity versus subjectivity is another one you need to consider when you form the passive portfolio. All right, once you identify the market benchmark or market index, then the next part is what are the methods for us to invest those index, right? So pretty much is the method of indexing portfolio. How do we create a portfolio to track the index? And here we have four popular methods. The most popular, or I would say in public, all right, so 80% of the index tracking portfolio are index mutual fund and the exchange trade fund ETF, index ETF. This is the largest one. And the other one, right, is pretty much the customized product. We have this called the SMA, right, or called separated management account, or called pool account, right? So these are more like a customized product. And then the other one is more like engineering type of product for this. And one is using the futures contract, relatively straightforward, using the futures to mimic or replicate the underlying index. Or a more sophisticated method is using the equity total return swap. Okay, equity return swap. Those are using the index to do some product, right? Using the benchmark, do it. Now, let's think about the ETF quickly. What is the difference between ETF and mutual fund? Okay, now there are some key differences. We have to be really careful and memorize it. Now, first of all, the most important advantage of using ETF is because ETF are continuously traded during the market during the market opening. Okay, once the market is open, it's tradable. However, the index fund, like a mutual fund, not an ETF, it can be traded once a day at the end of the day. Why? Because ETF and index fund, mutual fund are different in terms of their internal transaction. Index, if somebody want to redeem the share of ETF, inside the ETF, they have the principal participant. They through the in-kind transaction. In-kind mean they cannot just using money to change a share convert to money. They're using share versus share. So it's not going to change the underlying value. For the index mutual fund, you want to redeem that one, is a transaction between dollar money versus the share. So you got to sell the share and then put the money and then redeem the money. All right, redeem the share, sell the share, and then pay the money to the redeemer. So What happening when the mutual fund is that once you got the monetary transaction, it's going to interrupt the fundamental portfolio value. Therefore, you cannot trade constantly. You have to trade only one time at the closing. But ETF is in-kind trading. It's share with share exchange, so it can be traded continuously. That is a major difference and very important. Now, related to this one, it's immediately related to tax. Now, because ETF continuous trade is exchange fund, so it's just like a share trading in the stock exchange. So if you don't sell it, you don't have the capital gain, then you don't have to pay tax. However, all right, you only pay the realized capital gain tax. However, the mutual fund, index mutual fund, on the other hand, is different. Because regardless whether you have the realized gain or not, you have to pay tax because it's inside the fund's unit. Therefore, ETF had a more tax efficient and benefit there. Another one is a cost. ETF just like stock, and the only cost in the long term is commission cost. So it's much lower. Today, many transactions, you don't have to pay any transaction cost. So it's much lower. The only cost difference is bid and ask. But that is for the large ETF, that is very minimum. Okay, there's no need to have record keeping, all right, the bookkeeping fee in ETF. But for mutual fund, you implicitly have to pay that bookkeeping fee by, like for example, the filing for disclosure fee to SEC and so on. All those kind of fee, and that will be reflected to the investor, but not an ETF. Okay. Now, second part is the SMA account. This is more like I say, well, it's like a customized account. All right. The benefit for that is that you will have direct relationship between the manager and the investor. Okay. So the advantage is that here say that, okay, now lower management fee, all right, lower management cost, that's true, compared to the index fund or even the ETF. Our ETF also suggests subject to the fee to charge administration fee, but the SMA account, because it's customized, usually have a lower the cost. But here we got to make sure that there's differences between SMA and pool account. SMA, if you have invested with the SMA, then the SMA is one individual investor. They have the 100% right to own that particular portfolio. Where the pool account is different. The pool is that if you getting a partnership. There's several limited partner there, so like 5 guys into one account. So they share with that. Therefore, they don't have a one-to-one relationship. So this is the one you can read it by my statement here to understand that. All right. So it's a slightly difference, but there's the advantage or disadvantage there is based on pretty much the cost issue and the personal relationship with investor and manager. All right. Another one is instead of using the cash to buy stocks, why don't we just buy index futures? All right, index futures like S&P or QQQ, their futures contract. Right, so that way you have index directly, and it's cheaper because futures you don't have to pay really a huge amount. The futures contract only taking care of the net gain and loss. It sounds good, but the major problem is that one because future contract had a term. So the contract need to be renewed periodically. So usually the contract, let's say 1 year. But if you're holding for long term, you have to really continuously rolling over each year, have to rebalance. Now that's the problem. Once you rebalance by selling, when the old contract expire, then you got to replace the new contract. But remember, there's different term of contract. The price is different. So maybe when the time you want to replace, you have to buy a higher cost contract to replace the lower cost, lower value contract, old contract. So you may get it more and more and more. For example, when the time goes by to the 1 year, and then you own the near term contract to buy another brand new 1 year contract, you're going to have a higher cost. It's called contingent effect, right? So we have to be careful that involve a high cost when you have to rolling over for futures contract. Another one is if you want to have a portfolio using the futures, you're not able to short that one. All right, during when the price in the last price actually goes up because it violates the uptick rule. All right, the uptick rule, they say that if the last price is higher, then I'm sorry, the last price movement is decline, then you're not able to short. Right, so you can short only when the last price goes up. So in other words, that it reflects the problem that using the future you have more timing when you some kind of loss and cost when you do rebalance. Then another one is the equity total return swap. It's become very popular. It's more like a hedging strategy. It's that you exchange the return on equity and dividend, another interest rate. All right, and and then for the return for the interest that from a fixed income security. In other words, the equity swap is a swap between equity and bond through a dealer. So you give up all the capital gain and dividend by exchange the fixed, all right, interest income back. So that way you convert the dynamic equity price into a fixed return. To do that one, you don't have to sell the equity and buy the bond index. So it's very cost effective. Okay, it's cost effective diversification. So a lot of managers using their total portfolio, and then they take a part of the asset using the equity total return swap and swap to the fixed income, and without selling the equity and buy bond, it directly swap. So they have this cost effective. Another major advantage is tax advantage because you don't have a real transaction by selling and buying. So there's no realized gain and loss. So it's just a swap there, and the interest and everything there is really minimize your tax exposure here. All right, tax exposure. So it had a huge amount of tax advantage of that. I summarize here the benefit of using SMA. All right, is a direct relationship with the manager. That's a major advantage using the SMA. Just keep in mind next time when your client coming to you, tell them that setting up SMA is good because you have a direct relationship, customized relationship. And second one, the investor have a direct ownership of the security. Right? Since this is the customized product, so it can meet your investor need.